Hello and welcome to Unacademy, India's largest online learning platform where you get a world of courses, resources and content to choose from to help you in preparation of your examinations. Crack CA exams with us is a vertical that is started to help the students of CA Foundation, Intermediate and the final examination in their preparation for the examination. So I welcome you all to Unacademy once again, India's largest online learning platform, and come, let's crack the CA exams. Before we begin, a little about the educator today. Hello, I'm Prathik Gupta. I am a Bachelor of Commerce from Christ College, Bangalore University. I am also an associate member of the Institute of Chartered Accountants of India, an associate member of the Institute of Cost Accountants of India, and an associate member of the Institute of Company Secretaries of India. I am also a law graduate from Karnataka State Law University and currently a practicing chartered accountant. I am also a visiting faculty for CA subjects and an educator for CA students both offline and online. Prior to starting my own practice, I worked with SR Bartley Boy & Associates, that is the Indian member firm of Ernst & Young Global, also known as E&Y, in the Audit and Assurance Department, and E&Y, Ernst & Young India, in the Mergers and Acquisitions Department. I also worked with the Manipal Group and was the corporate controller of their German subsidiary located in Frankfurt, Germany. That's when I got back from Germany that I decided to start my own firm. And here I am today in front of you taking this session today. I welcome you all warmly to my session once again. Okay? Now, the Unacademy platform also has a plus subscription platform, which is a paid platform, which gives you many benefits. The benefits that the plus platform of Unacademy are, firstly, it gives you daily live classes. That is where you get to chat with your educator, engage in discussions, ask your doubts and answer polls, all while the class is going on. Yes, you heard it right. It's all while the class is going on. You do not need to take a separate appointment to talk to your You do not need to take a separate appointment to talk to your educator. You do not need to wait for a day, for a week. You do it as and when the doubt arises and the need for discussion arises. You get to do it with your live educator. You get to choose your favorite educator and the topic that interests you and get to attend that session, clear your doubts, have discussions, all on real-time basis. The Plus platform of Unacademy also conducts live tests and quizzes which help you evaluate your preparation with regular mock tests and quizzes and get detailed analysis on your performance. So what does the live tests and quizzes of the Plus platform of Unacademy enable you to do? It enables you to identify your strong areas, your weak areas, and your not so strong areas, so that adequate time can be spent on your not so strong areas and weak areas, and lesser time can be spent on your strong areas. So it just helps you in identifying your core areas and your weak areas so that you can prioritize and spend time accordingly. The courses provided by the Plus platform of Unacademy are structured courses. They are structured in the sense that all the courses are in line with the exam syllabus to help you best prepare for it, and utmost attention is paid to ensure that once you finish the courses on the Plus platform, you have also covered your syllabus to the maximum extent possible and no important topic or subject has been missed out. And lastly and most importantly, you get unlimited access to all your live and recorded courses to choose from the comfort of any of your devices. So what happens once you've taken the Unacademy Plus subscription, you get access to all the live and recorded courses that are contained therein, and you can view them from any of your devices at any location wherever you are. There is no bar or there is no mandate that you need to view them at this point or from this location. You can view it from any place you want, at any time you want, any number of times you want. So with these advantages in mind, I recommend the Plus platform of Unacademy to each one of you listening to me today, and I encourage you to become a part of it as soon as possible and reap the benefits from the platform. For those of you who have already downloaded the Unacademy Learning app and are using it, I thank you very much. For the ones who have not yet downloaded the Unacademy app, I request you to download the Unacademy app as soon as possible and make use of it. It's very simple. You get a mobile, you need to put in your mobile number, and once you put in your mobile number, you get an OTP. Using that OTP, you can register on the Unacademy Learning app. Now, what does that do to you? Unacademy Learning app. Unacademy Learning app will give you access to its world of courses, resources, and content. To carry in your pockets wherever you go, and in between your commute, in between your busy schedule, whenever you find the time, you can actually visit it and make the most of it whenever you feel like. That is the advantages. And see, there is nothing like, for example, in today's world when there is a lot of traffic and people are busy in their schedule running around, the Unacademy Learning app helps you that in between your busy schedule you can make the most of it and use it whenever you want, and clear your doubts and benefit from it. Just one second. Just one second. Okay, so again, for the people who have downloaded the Unacademy Learning app and are using it, I thank you very much. And for the ones who have not yet downloaded the Unacademy Learning app, I request you to download it as soon as possible and make the most of this opportunity. I hope to see you there soon. Like I said, the Plus platform of Unacademy is a paid platform. It's a paid and a subscription model kind of a platform. The CA Foundation and Intermediate subscription of the Plus platform of Unacademy gives you the following packages, which are, it gives you a package for 1 month, 3 months, 6 months, 12 months, and 24 months. The list price of the various packages are: the 1 month package costs you rupees 3,500. The 3 month package costs you rupees 8,750. The 6 month package costs you rupees 14,000. The 12 month package costs you rupees 17,500, and the 24 month package costs you rupees 21,000. While you are free to choose the package of your choice, please do not forget to use the code Prathik, Prathik, to get a discount of 10% on the listed price of your subscription. So the after discount price of the various packages are: the 1 month package of the CA Foundation and Intermediate subscription will cost you rupees 3,150. The 3 month package will cost rupees 7,875, which in turn will make it about 2,625 per month. The 6 month package will cost you about 12,600, which will further reduce your per month cost to about 2,100. The 12 month package will cost you rupees 15,750, making your per month subscription cost rupees 1,313. And the 24 month package will cost you rupees 18,900, thereby further reducing your monthly cost to about 788 rupees per month. So if you actually see the difference between the 1 month subscription and the 24 month subscription, the per month cost reduces very significantly, almost 1/3 of the cost of your 1 month subscription. Me as a professional and as an educator, I would personally recommend you to go for the 12 month or 24 months package for 2 reasons. One is it is cost effective. I just explained it to you. You look at the per month cost in the 24 month and the 12 month package, and you look at the per month cost in the 1 month package. It's almost half or less than 1/3 of the 1 month package. And also, when you prepare for your foundation and intermediate examination for the chartered accountancy course, you require a minimum period of about 1 year to do your preparations. So the 12-month package actually makes sense for you to apply for, because it gives you that much of time, and you're also getting both the CA foundation and the intermediate in one package. Okay, so I request you again, and I recommend you to either go for the 12-month or the 24 months package. Having said this, you're free to opt for the package you want. That is the 1 month, 3 months, 6 months, 12 months, and 24 months. And while you apply for the package that you want, please do not forget to use the code Prathik, Prathik, to get a discount of 10% on the listed price. The after discount listed price is on your screen. I request you to go through it and take a informed decision. You may take about a minute and go through the rates on your screen. So I look forward to seeing all of you aboard the Plus platform of Unacademy very soon. I will see you all there. Now, for the ones who have not yet followed my profile, I request you all to go to the Unacademy app, go to my profile, that is Prathik Gupta, PrathikGupta, and click on the follow button to get regular updates and timely updates about the time and the topic of my session, so that you do not miss it and can attend my sessions on time. I request all of you to attend my session, as I would love to be interacting with you on a live basis and also share my experiences and knowledge with you. So I request all of you to follow my profile, go to the Unacademy app, go to my profile and click on the follow button, and then you get regular and timely updates about the topics, the timings, and about my sessions, so that you can attend them. Now, if you go to the YouTube in my archives and type in Prathik Gupta, you will get a lot of topics and sessions that I've taken about. I've taken sessions on the various aspects of Companies Act, the various aspects of Income Tax Act 1961, the Indian Contracts Act, the Indian Partnership Act, the Limited Liability Partnership Act, and other acts. So there are various sessions of mine which are there on YouTube and also on the Unacademy platform. I request all of you to go through those sessions and share your observations and feedback with me. If you have any questions on topics, I would be more than happy to answer it to you. So please feel free to go through the archives on YouTube, go to all my sessions, all the previous things that I've spoken about, and get back to me for doubts if you have. I will also be taking a lot of sessions further on YouTube for your benefit on the various topics that could interest you and will benefit you. I request you all to stay tuned and make the most of it. All right, thank you so much. Let's proceed. So the topic that we're going to discuss today is income from house property part 2. I call it part 2 because part 1 is already taken and it is present on YouTube, wherein I have discussed the basics of income from house property, which is a subject, which is a topic under the Income Tax Act 1961. So in the part 1, I have discussed about what is house property, what are the various types of house properties, and how do you calculate the gross annual value and the net annual value. I have discussed all that in my part 1. So the people who have missed my part 1, I request you all to go to YouTube and look and go through my part 1, that is income from house property, to gain more understanding and knowledge of what are the basics of income from house property. But do not worry, we will also be taking a quick recap of what you missed in part 1 today before we go into today's session. So I request you, all of you, to stay tuned, and in case you have any questions or any doubts, please ask me as and when you have them. All right, so let's start off with income from house property part 2. This is a quick recap of what we missed in part 1. So I might be a little fast on this because I have already, and if a person is getting rent from such a property, then that income or that rent is chargeable under the head income from house property. Okay, this is to start off with the introduction. Like I said, I will be a little fast on the recap until we reach today's topic. The conditions for chargeability. The property should consist of any building or land appurtenant thereto. Buildings include not only residential buildings but also factory buildings, offices, shops, godowns and other commercial premises. Land appurtenant means land connected with the building, like garden, garage, etc. So buildings will not only mean residential building but also factory buildings, offices, shops, godowns and other commercial premises. And if there is anything else attached to the land in the form of garden or garage, that will also be included in the definition of buildings, okay, in the definition of property. Assessee must be the owner of the property. Now we look at another few conditions which are important for income to be chargeable under the head income from house property. The assessee must be the owner of the property. First one, assessee is the person who is entitled to receive income from the property in his own right. That means he should be the owner, or he should have a right to receive the income. No one should be able to object or dispute that right with which the assessee has or the owner has in receiving that income. All right. So now, when does a dispute or a thing come? When dispute comes when a person does not have an absolute right or the entitlement is not absolute. In that case, the owner is not entitled to receive the rent. So then it becomes a question mark as to who is entitled to receive the rent. The requirement of registration of sale deed is not warranted. Sometimes what happens, the sale of property happens from a person from A to B, but B does not get it registered in his name for XYZ reasons. Maybe due to a problem, like for example during Corona, the registration offices were closed, so he was not able to register it, but still he has the sale deed based on which he is entitled to that property. So based on that sale deed, which makes him entitled to that property, he is entitled to receive rent from that property. In that case, he will be the deemed owner even though the registration of the sale deed is not happened. So registration of sale deed is not a mandatory requirement in order to get income from house property. Even without the registration of sale deed, you can still get income from house property. Ownership includes both freehold land and leasehold rights. Now, for example, if a person has a property which is free of all charges, in that case it is called as freehold land. And in case he obtains a property on lease and then he further rents it out, in that case it is known as leasehold land. In both the cases, the income of that person from house property will be income under house property under Income Tax Act 1961. Ownership also includes deemed ownership. Deemed ownership, like I told you, is again in the second point we spoke about, that the sale deed, registration of sale deed is not mandatory, and that makes it in ownership is as deemed ownership. That means if a person is deemed or assumed to be the owner, and he also enjoys all the rights that the owner of a property has, and he also enjoys the risks and rewards of that, in that case he will be entitled to earn income from house property. The person who owns the building need not also be the owner of the land on which it stands. So it is possible that he can take a land on rent, build a building on it, and give that building out for rent. So once he gives that building out for rent, whatever income he earns from that building is still chargeable to tax under income from house property, even though he does not own the land. Use of property. The property may be used for any purpose, but it should not be used by the owner of the owner for the purpose of any business or profession carried on by him, the profit of which is chargeable to tax. So the owner of the property should not use that property for his own business. In that case, it will be charged to the profit is chargeable to tax. In that case, it will be income from other sources or income from business or profession. So that property should not be used by the assessee, but he can give it out for any other purpose. In such a case, it can be deemed as income from house property. Property held as stock in trade. Now, what do you mean by how property held as stock in trade? Now, let's say we have a real estate agent or a developer or a builder who has built about 500 flats. Okay, now has he built those 500 flats for himself to stay in those flats? No, right? He has built those flats because he wants to sell them. His own business is to make properties or make flats and sell them, or buy property or flats and sell them in turn. So in that case, when the properties are held as stock in trade, now like for example, a person who does a business in furniture, he will own furniture as stock in trade. Stock in trade simply means the stock that you're ready to buy and sell to make a profit. Okay, so if a person has any property which he owns in order to buy and sell in order to make profit, then it will be termed as a stock in trade. So in case it is a stock in trade, then the income that is derived from that will not be income from house property, but it will be income from business or profession. So annual property of a house will be charged under the head income from house property, where it is held by the assessee as stock in trade of a business also. However, the annual value of property being held as stock in trade will be treated as nil for a period of 2 years from the end of the financial year in which certificate of completion of construction of the property is obtained from the competent authority, if such property is not let out during the period. Okay. Now, what do you mean by composite rent? Now, composite rent is an interesting topic. The meaning of composite rent: the owner of a property may sometimes receive rent in respect of a building as well as other assets, say furniture, plant and machinery. So along with the rent for the property, he also receives rent for other things, like say he is providing the furniture, plant and machinery. For different services provided in the building, that is lifts, security, power backup, etc. also he might be charging an amount. The amount so received is known as composite rent when he receives it as a lump sum. That is the rent for the property along with rent for say furniture, plant and machinery, lift, security, power backup, etc. If he receives the amount for all of these put together, it will be termed as composite rent. Tax treatment of composite rent, where composite rent includes rent of building and charges for different services like lifts, security, etc. The composite rent is to be split in the following manner. The sum attributable to use of property is to be assessed under section 22 as income from house property. The sum attributable to use of services is to be charged under head business and profession of business of profits and gains of business profession, or under the head income from other sources. So if it is possible, to split that amount into rent for the property and rent for the special services. In that case, the rent for the property will be charged under income from house property, and the rent for the services will be charged either under income from business or profession or income from other sources, as the case may be. Manner of splitting up. Where composite rent is received from letting out of building and other assets like furniture, and the two lettings are not separable, and the other party does not accept letting out of building without other assets, then the rent is taxable either as business income or from income from other sources. So if they're not able to break up that amount between income from rent from property and from other services, then the entire income will be charged under business income or from other sources, as the case may be. Please take a minute and go through this slide, and then we proceed. Take about 30 seconds more, and then we proceed. Income from house property situated outside India. So now what happens in a situation where the house property is situated outside India? In case of a resident in India, resident and ordinary resident in case of individuals in HUF. Now for residential status, I have also taken sessions on residential status under the Income Tax Act 1961, and those topics are present on YouTube. I request you all to go through that session where it is explained how do we determine the residential status of individuals in HUF. This is important because every year we need to determine the residential status in order to know the taxability of certain items and the non-taxability of certain items. So in case you have missed it or you want to know more about it, I request you to go through the session on residential status present on YouTube and give me your feedback and ask me any questions that you may have. So in case of resident, if a resident in India, resident and ordinary resident in case of individuals and HUF, income from property situated outside India is taxable whether such income is brought into India or not. So one of the main aspects of residential status of a person is that if a person is a resident and an ordinary resident, that is an individual or a HUF, only they can be resident and ordinary resident, then the global income is taxed in India. So whether you earn that income from house property outside India or in India, it doesn't matter. That amount will be taxable in India. That's one of the major features of being a resident and ordinary resident. Okay. Then in case of a non-resident or a resident but not ordinary resident, income from a property situated outside India is taxable only if it is received in India. So you see the difference. For a resident and ordinary resident, any income in any part of the world, whether it's received in India or not, is taxable in India. But for a person who is a non-resident or a resident but not ordinary resident, the income received from a house property outside India, income from a house property outside India but received in India, only then it will be taxable in India. Otherwise, it will not be taxable in India. Determination of annual value. This is an important concept. Please remember, I'm recapping what we did in part 1. First, we have a determination of gross annual value. From that, we deduct municipal taxes paid by the owner during the previous year, and then that gives us the net annual value or NAV. Now, how do we find out the GAV for the house property? Where the property is let out throughout the previous year, where the property is let out for the whole year, then the GAV will be the higher of expected rent and actual rent received or receivable during the year. Expected rent simply means the rent that a similar property will fetch in the same locality in case it is let out, and that is compared with the actual rent received or receivable, and whichever is higher will be the gross annual value. From that amount, the municipal taxes paid by the owner during the previous year is to be deducted to arrive at the NAV. So municipal taxes are certain taxes that are levied by the local authorities or municipal authorities for the upkeep of the properties. So in that case, whatever municipal taxes are paid during a particular year by the owner of the property, that will be allowed as deduction to arrive at a net annual value. Now let's look at an example. Example, J owns 5 houses in Chennai, all of which are let out. Compute the gross annual value of each from the information given below. Alright, so now first and foremost, please remember there is a sequence. First, we compare the municipal value and the fair rent. Municipal value is the value determined in order to levy taxes. Municipal taxes are always levied on the municipal value. Fair rent of a property simply means the rent that a similar property will fetch in the same locality in case you have not let out the property. And standard rent means certain states have a rent control act, and as per that rent control act there is certain limitations or ceilings on the amount of rent that you can charge. So that will be, it's given by the standard rent. Actual rent received or receivable is if a property is let out, then what is the rent that you will receive on an annual basis, or what is the rent that you're expected to receive on an annual basis will form part of actual rent received or receivable. So this is the sequence of comparison. First, we compare the municipal value and the fair rent, and we select the higher of those amounts. Then from the higher of those amounts, we compare it with the standard rent, and we select the lower of those amounts. From that lower of the amount, we compare it with the actual rent received or receivable, and whichever is the higher, we take that as the gross annual value. Please take about 30 seconds, go through this question, and then we look at the solution. So here we see the municipal value of house 1 is 80,000, house 2 is 55,000, house 3 is 65,000, house 4 is 24,000, house 5 is 80,000. The fair rent of house 1 is 90,000, house 2 is 60,000, house 3 is 65,000, house 4 is 25,000, and house 5 is 75,000. The standard rent of house 1 is 0, house 2 is 75,000, house 3 is 58,000, house 4 is 0 again, house 5 is 78,000, and the actual rent received or receivable of house 1 is 72,000, house 2 is 72,000, house 3 is 60,000, house 4 is 30,000, house 5 is 72,000. Now let's look at the solution. As per section 23(1), gross annual value is the higher of expected rent and actual rent received. Expected rent is higher of municipal value and fair rent but restricted to standard rent. What I told you, we need to compare municipal value and fair rent, calculate and then select the higher of those two. From the higher of that two, we compare it with standard rent and select the lower of the two. With the lower of the two, we compare it with the actual rent received or receivable, and we calculate and we select the higher of the two. That's how we get the gross annual value. So that let's quickly look at the solution for this. So let's look at house 1. In case of house 1, between municipal value and fair rent, whichever is higher, we select that as first choice. So 90,000 is selected. Now we compare 90,000 with the standard rent of house 1, that is 0, and which we select the lower amount. So which is the lower amount? 0. Now that 0 we compare it with actual rent receivable of house 1, that is 72,000, and select the higher one. So 72,000 becomes the gross annual value. Similarly, let's look at house 2. Between 55,000 and 60,000, we select the higher one, so we select 60,000. With 60,000, we compare it with 75,000 and select the lower one, so the expected rent becomes 60,000. Expected rent of 60,000 is then compared with amount actual rent received or receivable 72,000, and we select the higher one. House 3, 65 is compared with 65, so we select 65. Then 65,000 is compared with the standard rent of 58,000, and the lower one is selected, so we select 58,000. 58,000 is compared with 60,000, and we select the higher one, so we get 60,000. House 4, 24,000 is compared with 25,000, and we get the higher of those two, we select 25,000. 25,000 is compared with 0, and we select the lower one, so 0 is selected. Expected rent of 0 is compared with actual rent received or receivable of 30,000, and 30,000 is selected as the gross annual value. House 5, 80,000 and 75,000 are compared, and we get 80,000. 80,000 is compared with standard rent of 78,000, and we select 78,000. 78,000 is compared with 72,000, and the higher of 2 is selected, and we get 78,000 as the gross annual value. Please take a minute, go through this slide, and then we proceed. I hope you got this, and in case you have any questions, please ask me. Okay. Now see, there are different cases. Now there might be cases where a property is self-occupied or it is let out. Self-occupied means the person who's the owner of the property is living in that property. And there might be cases where a person has two properties and one he's staying in and one he has let out. Or there might be a third situation in which he is staying in a property for 6 months and he's let it out for 6 months. So in all these cases, how do we calculate the GAV and NAV? We will discuss that quickly. Where let out property is vacant for part of the year. Where let out property is vacant for part of the year and owing to vacancy, the actual rent is lower than the expected rent, then the actual rent received or receivable will be the gross annual value of the property. In case of self-occupied property or unoccupied property, where the property is self-occupied for own residence or unoccupied during the previous year, its annual value will be nil, provided no other benefit is derived by the owner from such property. The benefit of nil annual value is available only for up to two self-occupied or unoccupied house properties. That is either for one house property or for two house properties. So a person, if he has two properties, he can opt both as self-occupied property and the gross annual value of both these properties will be 0. Okay, but he should not have let out the property to any person. The benefit of nil annual value in respect of up to two self-occupied properties is available only to an individual or HUF. No deduction for municipal taxes is allowed in case of such property. So self-occupied properties are not entitled to get a municipal taxes deduction. Where a house property is let out for part of the year and self-occupied for part of the year, please remember I'm going through this as a recap. We have done this in part 1. I request everyone to go through YouTube and go through the part 1 of this. Where the house property is let out for part of the year and self-occupied for part of the year, if a single unit of a property is self-occupied for part of the year and let out for the remaining part of the year, then the expected rent for the whole year shall be taken into account for determining the gross annual value. The expected rent for the whole year shall be compared with the actual rent for the let out period, and whichever is higher shall be adopted as gross annual value. However, municipal taxes for the whole year is allowed as deduction provided it is paid by the owner during the previous year. Now, what happens in case of a deemed let out property? What is a deemed let out property? Let's say a person has 3 properties. Okay, so any 2 properties he is free to treat it as self-occupied, but the third property he has to pay taxes on it, because even though he's not let it out, but based on the rent that that house receives in the similar locality, he will be charged to income tax. So in his case, what happens? Let's look at that. Where the assessee owns more than 2 properties for self-occupation, then the income from any 2 properties at the option of the assessee shall be computed under self-occupied property category and their annual value will be nil. The other self-occupied unoccupied property shall be treated as deemed let out properties. This option can be changed year after year in a manner more beneficial to the assessee. In case of deemed let out property, the expected rent shall be taken as gross annual value. The question of considering actual rent receivable does not arise because the property is deemed let out. It is not actually let out. No adjustment is necessary on account of property remaining vacant or unrealized rent. Municipal taxes paid by the owner during the previous year in respect of deemed let out property can be claimed as deduction. In case of house property, a portion is let out and a portion is self-occupied. Now, how do you treat it in this case? Let's have a look quickly. Income from any portion or part of the property which is let out shall be computed separately under the let out property category, and the other portion or part which is self-occupied shall be computed under the self-occupied property. There is no need to treat the whole property as a single unit for computation of income from house property. Municipal valuation, fair rent, standard rent, if not given separately, shall be apportioned between the let out portion and the self-occupied portion, either on plinth area or built up floor space or such other reasonable basis. Property taxes, if given on consolidated basis, can be bifurcated as attributable to each portion or floor on a reasonable basis. Now, treatment of unrealized rent. What do we mean by unrealized rent? Quickly, unrealized rent is a rent that your tenant has not paid you or he refuses to pay you. In this case, what do? I am going through this quickly because all this has been done in part 1. I request all of you to go to YouTube and go to my part 1 to know more about this in detail. The actual rent receivable should not include any amount of rent which is not capable of being realized. However, the conditions prescribed in Rule 4 should be satisfied. They are: the tenancy is bona fide, the defaulting tenant has vacated or steps have been taken to compel him to vacate the property, the defaulting tenant is not in occupation of any other property of the assessee, and the assessee has taken all reasonable steps to institute legal proceedings. So please note, for any rent to be termed as unrealized rent, the 4 conditions are important. One is the tenancy should be legal, the defaulting tenant has vacated or steps have been taken. That means you should have sent him a notice that as you've not paid me the rent, please vacate my property. And the defaulting tenant should not be in possession of any other property of the assessee, and the assessee has taken all reasonable steps to initiate legal actions for recovery of unpaid rent. So if these 4 conditions are fulfilled and still the rent has not come in, then that rent will be termed as unrealized rent. Now, what are property taxes? Now we need to remember, and from here I think we discuss about today's sessions. Property taxes are allowable as deduction from the gross annual value subject to the following conditions. It should be borne by the assessee and it should be actually paid during the previous year. So like I said, previous year is any year before the assessment year. So 1st April 2019 to 31st March 2020 is the previous year. The assessment year for this previous year will be from 1st April 2020 to 31st March 2021. Okay, so the conditions are it should be borne by the assessee, that is the owner, and it should actually be paid during the previous year. If property tax is levied by a local authority for a particular previous year are not paid during that year, no deduction shall be allowed. So please remember, the deduction of municipal taxes will be allowed only if that amount is paid. If it is not paid, there is no deduction. However, if in any subsequent year the arrears are paid, then the amount so paid is allowed as deduction. So if you have not paid for 2 or 3 years and all 2 or 3 years combined you paid last year, then the entire amount will be allowed as deduction in the last year. In case of property situated outside India, taxes levied by local authority of the country in which the property is situated is deductible. Even if your house property is situated outside India, whatever municipal taxes you pay there is allowed as deduction. In respect of self-occupied, unoccupied house properties for which nil annual value is claimed, deduction of municipal taxes is not allowed. So for self-occupied property or for any other property where the gross annual value is nil, you cannot deduct municipal taxes because you cannot have anything deducted from zero. Let's look at a small example. R, a British national, is a resident and ordinarily resident in India during the previous year 1920. He owns a house in London which he has let out for £10,000 per month. The municipal taxes paid to the Municipal Corporation of London is £8,000 during the previous year 1920. The value of £1 in Indian rupees to be taken as 92 rupees 50 paise. Compute R's net annual value for property 2020-21. Firstly, we need to determine his residential status. Now, for the previous year 2019-20, R, a British national, is a resident and ordinary resident because it's given in the question. Therefore, income received by him throughout the world, because he's a resident and ordinary resident, income received by him in London also will be taxed in India. So from that property or that income, you can deduct municipal taxes that are paid in London. Let's look at the working. The gross annual value will be rupees 10,000 into 12. Why 10,000? Because he's let it out for 10,000 rupees per month. So 10,000 into 12 into 92.5, that is rupees 1 crore 11 lakhs. Less municipal taxes. He is paid municipal taxes of £8,000. So 8,000 pounds into 92.5, that is rupees 7 lakhs 40,000. So the net annual value is 1 crore 11 lakhs minus 7 lakh 40,000. That is 1 crore 3 lakh 6. 1 crore 3 lakhs. 1 crore 3 lakhs and 60,000. All right. Take about a minute and go through the slide and then we proceed. This was a simple example. Okay, now from the annual value, now you have calculated the gross annual value. That is, you've compared the fair rent with municipal value, selected the higher one. With the higher one, you've compared it with standard rent, selected the lower one. From the lower one, you've compared it with actual rent received or receivable and found out the higher one. So now you've got your gross annual value. From the gross annual value, you have deducted the municipal taxes paid in the previous year. Irrespective of which year it is, you have deducted the municipal taxes. So gross annual value minus municipal taxes, you have got net annual value. Agreed? Now from the net annual value, section 24 allows you certain other deductions from income from house property, which we will discuss. Now, there are two deductions from annual value. They are 30% of NAV. The Income Tax Act provides you a blanket deduction of 30% of NAV. No questions asked. Those 30% of NAV covers all your repairs, renewals, your your other painting and your other charges, what you have paid for the property, all that is included in 30%. You cannot claim anything more than 30%. And also interest on borrowed capital. So if there is any money that you have borrowed in order to construct or renovate or to buy a particular property, whatever interest you pay on that is also allowed as deduction, subject to certain terms and conditions, which we will see now. First one, 30% of NAV is allowed as deduction under section 24A. This is a flat deduction and is allowed irrespective of the actual expenditure incurred. Like I told you, it's a blanket deduction, no questions asked. Every person who has income from house property gets this 30% flat deduction. The assessee will not be entitled to 30% in following cases as annual value is nil. So in case it is a self-occupied property, so the gross annual value of a self-occupied property is 0. From 0 you cannot deduct municipal taxes, so your net annual value also is 0. In that case, you cannot further go on deducting 30% because 30% of 0 is also 0. Okay, so in case of self-occupied properties, or in case of properties held as stock in trade and whole or any part of the property is not let out during the whole or any part of the previous year, up to 2 years from the end of the financial year in which certificate of completion of construction of property is obtained by the competent authority. So in these two cases, that is either self-occupied or it is held by stock in trade and whole or part of the property is not let out during any or whole of the previous years, up to 2 years from the end of the year in which it is completed. So for 2 years, it will be treated as self-occupied property. After that, it will be treated as deemed let out property. Interest on borrowed capital is allowed as deduction under section 24B. Now we look at the second deduction, that is the interest on borrowed capital. Interest payable on borrowed capital for the purpose of acquisition, that means purchase, construction, repairs, renewal or reconstruction. Reconstruction means renovation, can be claimed as deduction. Interest payable on fresh loan taken to repay the original loan raised earlier for the opposite purposes is also admissible as deduction. So in case you had a loan for the purpose of purchase of a property, to repay that loan, you took another loan. So on that second loan, whatever interest you pay again is allowed as deduction under section 24B of the Income Tax Act 1961. Now, please remember what there is. See, now you have, let's say you have taken a loan for the construction of a property. Now, the construction of the property might take 2 years, 3 years, 4 years, 5 years. But your interest payment starts from the time you take the loan. So, what about the interest paid for the pre-construction period? Pre-construction period means the years before the year in which the construction was completed. So, let's look at that. Pre-construction period is the period prior to the previous year in which property is acquired or construction is completed. Interest payable on borrowed capital for the period prior to the previous year in which the property has been acquired or constructed, that is called the pre-construction period, as reduced by any part thereof allowed as deduction under any provisions of the Act, can be claimed as deduction over a period of 5 years in equal installments commencing from the year of acquisition or completion of construction. Now let's say a person took a loan of 10 lakhs at 10% on 1st April 2016. Okay, so he took 10 lakhs loan at 10%. So for 16-17, what is the loan? What is the interest he paid? 1 lakh. For 17-18, what is the interest he paid? 1 lakh. For 18-19, what is the interest he paid? 1 lakh. Let's say the property was completed in the financial year 1920. So what is the pre-construction interest? 16-17, 17-18, 18-19, that is 1 lakh each, 3 lakhs. So what does this explanation say? That amount of 3 lakhs will be allowed as 5 equal installments from the year in which the project is completed. So the project or the house was completed in 1920. So 3 lakhs divided by 5. 60,000 will be allowed for each year beginning from 1920, 2021, 21, 22, 22, 23, 23, 24. So for these 5 years, you will be allowed pre-construction interest of 60,000 rupees each year. Okay. Interest for the year in which the construction is completed. And so in the year 1920, when the construction is complete, for that year, whatever interest you pay, everything will be allowed at actual, subject to terms and conditions. Please take about a minute, go through this slide, and then we proceed. It's an important slide. Okay. Now, deduction in respect of self-occupied or unoccupied property where nil value is nil. Let's look at the first case. Now, let's say the property is self-occupied. In that case, the gross annual value is 0 and the net annual value is 0. You also don't get a standard deduction of 30%. So, okay. In that case, how much of interest is allowed as deduction? Let's look at that. First case, in case the assessee will be allowed as a deduction on account of interest, including 1/5 of the accumulated pre-construction period as under. First case, if the loan is borrowed before 1st April 1999, where the property has been acquired, constructed, repaired, renewed or reconstructed with borrowed capital prior to 1st April 1999, actual interest payable in aggregate for one or two self-occupied properties subject to a maximum of 30,000 rupees. So if the loan has been taken before 1st April 1999, then the maximum interest allowed for a self-occupied property will be only rupees 30,000 per self-occupied property. Okay. Loan borrowed on or after 1st April 1999, where the property is acquired or constructed with capital borrowed on or after 1st April 1999, and such acquisition or construction is completed within 5 years from the end of the financial year in which the capital is borrowed. Actual interest payable in aggregate for one or two self-occupied properties subject to maximum of rupees 2 lakhs if certificate is mentioned. So in case the loan is taken after 1st April 1999, then for the first self-occupied property and the second self-occupied property in total, the interest allowed is rupees 2 lakhs, subject to get a certificate from the loan provider. Where the property is repaired, renewed, reconstructed with the capital borrowed on or after 1st April 1999, the actual interest payable in aggregate for one or two self-occupied properties subject to rupees 30,000. Okay. Now, in case it is repaired, a property is repaired or renovated for taking a loan after 1st April 1999, in that case, the maximum interest allowed is 30,000. But in case it is constructed or acquired, then the loan allowed is 2 lakhs. Let's take an example. Mr. M owns two properties, one at Mumbai, wherein his family resides, and the other one in Delhi, which is unoccupied. He lives in Chandigarh for his employment purposes in a rented house. For acquisition of house property at Bombay, he has taken a loan of rupees 30 lakhs at 10% per annum on 1st April 2018. He has not repaid any amount so far. In respect of house property at Delhi, he has taken a loan of rupees 5 lakhs at 11% per annum on 1st October 2018 towards repairs. Compute the deduction which would be available to him under section 24B for assessment year 2020-21 in respect of interest payables on such loan. Alright, so he's got one house in Bombay, one house in Delhi. For the Bombay house, he took a loan of 10 lakhs, 30 lakhs at 10% on 1st April 2018. For the Delhi house, he took a loan of 5 lakhs at 11% on 1st October 2018 for repairs. Now we need to calculate the amount of deduction allowed under section 24B. Let's look at the solution. Interest on loan taken for acquisition of residential property at Bombay is rupees 30 lakhs into 10%. That is 3 lakhs restricted to 2 lakhs. Why? Because it is a self-occupied property. So the restriction is 2 lakhs and the property is taken after 1st April and the loan is taken after 1st April 1999. Interest on loan taken for repairs of residential property at Delhi, 5 lakhs into 11%, that is 55,000. But restricted to 30,000. Why? Because the loan is taken after 1st 1/4/1999 for repairs or renovation of the property. So in that case, the interest is limited to 30,000. So deduction under section 24 in respect of A1 and 2 above will be restricted to rupees 2 lakhs. 2 lakhs plus 30,000 should be 2,30,000, but the amount is restricted to 2 lakhs. Please take a minute, go through the solution, and then we proceed. Take about another 30 seconds, go through the solution, and then we proceed. Okay, now the important points regarding the deduction under section 24B. The ceiling or limit would not apply to let out or deemed let out property. The ceiling prescribed for self-occupied property as above in respect of interest on loan borrowed does not apply to a let out or deemed let out property, which simply means the limit of 2 lakhs and 330,000 given for before 1/4/1999 and after 1/4/1999 shall not apply for a property that is let out or deemed let out. In that case, the actual interest paid, irrespective of the amount, will be allowed as deductions. Interest allowable on accrual basis. Deduction under section 24B for interest is available on accrual basis. Therefore, interest accrued but not paid during the period can also be claimed as deduction. So this is unlike municipal taxes which need to be paid during that year. If you have interest that you need to pay in a particular year, but like for example in COVID you got a moratorium and you did not pay it, then in that case, even though it was accrued and you didn't pay it, you can still claim that interest as deduction in that previous year. Unpaid purchase price will be considered as capital borrowed. Where a buyer enters into an arrangement with a seller to pay the sale price in installments along with interest thereon, the seller becomes the lender in relation to the unpaid purchase price and the buyer becomes the borrower. In such a case, unpaid price can be treated as borrowed capital for acquiring property and interest paid thereon. So let's say a person has bought a property from another person for payment in installments, and the buyer says, okay, I will pay you in installments along with interest. So even that interest what he pays to the seller will be allowed as deduction under section 24B. Interest on unpaid interest is not includable, so no interest on interest can be claimed as deductions. Now let's look at one example where the property is let out for the whole year. So let's look at a proper example as to how we calculate the income chargeable under the head house property. All right. Example, A has a property whose municipal valuation is rupees 1,30,000 per annum. The fair rent is rupees 1,10,000 per annum. And the standard rent fixed by the Rent Control Act is rupees 1,20,000 per annum. The property was let out for a rent of rupees 11,000 per month throughout the previous year. Unrealized rent was rupees 11,000 and all conditions prescribed under Rule 4 were satisfied. He paid municipal taxes at 10% of municipal valuation. Interest on borrowed capital was rupees 40,000 for the year. Okay, compute the income from house property of A for assessment year 2021. So they've given us all the details and now we need to compute the income from house property of A for assessment year 2021. Let's look at the solution. First, we compute the expected rent. So the higher of municipal value of 1,30,000 per annum and fair rent of 1,10,000 per annum will be compared, and we will take the standard rent of rupees 1,30,000. We'll take the standard rent of rupees. We'll take the municipal value of rupees 1,30,000. This 1,30,000 we will further compare with the standard rent of rupees 1,20,000 and take the lower one. So the expected rent is equal to 1,20,000. All right. Now that 1,20,000 we will compare with the actual rent received or receivable. What is the actual rent received? 11,000 into 11, that is 1,21,000, because 1 month was unrealized rent. So we compare 1,20,000 and 1,21,000 and select the higher of the two to get the gross annual value. So what will be the gross annual value? The gross annual value will be rupees 1,21,000. Now from the 1,21,000 we will reduce the municipal taxes at 10% of municipal value. So the municipal value was rupees 1,30,000. So 10% of 1,30,000 is 13,000. So 1,21,000 minus 13,000 will give us 1,08,000. So the net annual value is rupees 1,08,000. From 1,08,000 now we need to make two deductions. One is a 30% standard deduction and one is interest on borrowed capital. Let's have a look at that. So the municipal value, net annual value we got as 1,08,000. From that we deduct 30% of NAV. So 30% of 1,08,000 will be 32,400 and the interest on borrowed capital actual without any ceiling limit is 40,000. Why is this? Because it is a let out property. So on a let out property the entire interest paid without any ceiling is allowed as deduction. So from net annual value of 1,08,000 we deduct 32,400 and we deduct 40,000. So we get the income from house property as rupees 35,600. Please take a minute, go through the solution and ask me any doubts you have. Please ask me any questions you have. Okay, now let's look at a second case. The let out property vacant for part of the year. Now you have let out a property, given it on rent, and it is vacant for part of the year. In this case, how do we do it? G has a property whose municipal valuation is rupees 2,50,000 per annum. The fair rent is rupees 2 lakhs per annum. And the standard rent fixed by the Rent Control Act is rupees 2,10,000 per annum. The property was let out for a rent of rupees 20,000 per month. However, the tenant vacated the property on 31st Jan 2020. Unrealized rent of rupees 20,000 and all conditions prescribed by Rule 4 are satisfied. He paid municipal taxes at 8% of municipal valuation. Interest on borrowed capital was rupees 65,000 for the year. Compute the income from house property of G for assessment year 2021. Okay, so let's look at the solution. Again, we do the whole exercise about comparing municipal value with the fair rent, then comparing that number with standard rent, and then comparing that number with the actual rent receivable. So let's look at that. So the municipal valuation of the property is 2,50,000. That we compare with the fair rent of 2 lakhs. Whichever is higher, we take that. So 2,50,000. Then the 2,50,000 we compare it with the standard rent of 2,10,000 and select the lower of the two. So 2,10,000 is taken as the expected rent. That amount of 2,10,000 has to be compared with the actual rent received or receivable. Now, what is the actual rent receivable? 20,000 into 12, 24,000. But it was vacant for how many months? 2 months, right? So 20,000 into 10 is 2 lakhs, and also you have an unrealized rent of rupees 20,000. So the actual rent received will be 2 lakh minus 20,000, that is 1,80,000. Okay, now we need to compare the actual rent received and receivable with the expected rent, and we need to take whichever is higher. So 2,10,000 is to be compared with 1,80,000, and we need to select 1 lakh, and we need to select 2,10,000. But if you remember what we spoke in the earlier slides, if the actual rent received or receivable of a property is lower due to its vacancy, in that case we will take the actual rent received or receivable as the gross annual value. So in this case, even though 1,80,000 is lower than 2,10,000, but if that property was let out till 31st March 2020, the rent would have been increased by 40,000. So the actual rent received or receivable would have been 2,20,000. So in this case, we will take 1,80,000 as the gross annual value. From the gross annual value of 1,80,000, we reduce the municipal taxes paid. That is 8% of 2,50,000. That is rupees 20,000. We get the net annual value of rupees 1,60,000. From the 1,60,000 rupees, we make deductions under section 24. That is 30% of NAV. That is 30% of 1,60,000 is equal to 48,000. And interest on borrowed capital without any ceiling limit is 65,000. So 1,60,000 minus 48,000 minus 65,000 will give us income from house property of rupees 47,000. I request you to go through this solution, and in case you have any questions or any doubts, please ask me. Okay, yeah, take about another 30 seconds and go through the solution. We will be ending today's session with this. I will continue on income from house property part 3 as well, to help you with some more illustrations and examples to understand better. And like I told you, Unacademy is the is India's largest online learning platform, and I welcome you to it. And I also welcome you to crack CA exams with us. That is a vertical of Unacademy that helps CA students of the foundation, intermediate, and final course in preparation for their CA examinations. So let's crack CA exams with us. And then the Unacademy also has a Plus platform, like I told you earlier, which is a subscription-based model. And once you subscribe to the Plus platform, what do you get? You get daily live classes where you get to chat with your educator, engage in discussions, ask your doubts and answer polls. All this while the class is going on. You do not need to wait for a particular time or appointment. You can do this as and when the classes are going on. You can talk to your educator and clear all your doubts and discussions. Then also the Plus platform of Unacademy provides live tests and quizzes which help you evaluate your preparation with the mock tests and quizzes and get detailed analysis for your performance, which help you identify your weak areas, your strong areas, so that you can spend more time on your weak areas and lesser time on your strong areas. The courses provided by the Plus platform of Unacademy are structured. They are structured in such a way that they are in line with your exam syllabus and help you best prepare for it, and best efforts are made so that no important point of your syllabus is missed while you prepare or complete the courses provided by the Plus platform of Unacademy. And lastly and most importantly, the Plus program of Unacademy provides you unlimited access, so that one subscription gets you access to all the live and recorded courses to watch from the comfort of any of your devices. You can either watch it from your mobile phone, your laptop, your tablet, or your desktop without any restrictions, and you can watch it at any time you want, 24/7. You can select your educator, you can select your topic, and access it whenever you want, wherever you want. So I really hope you all make use of the Plus platform of Unacademy and get on board as soon as possible. For the ones who are already using the Unacademy learning app, I thank you very much. And for the ones who are not yet using it, I request you to download the Unacademy learning app from your Play Store and register on it using a simple process. You need to put your mobile number where you get an OTP, and then you use that OTP and register on it, and it opens your gateway to the courses, resources, and contents that Unacademy has to provide to you. You can carry the entire world of Unacademy, the live and recorded courses and sessions and lectures in your pocket, in your mobile, and access it and learn from it at any point of time. Whether you're in commute, whether you're in bus, whether you're in a taxi, whether you're waiting outside for a meeting, you can access it whenever you want. So I encourage you and I request you to make use of the Unacademy learning app as soon as possible and get on board the Unacademy learning app as soon as possible. The CA Foundation and Intermediate packages provided by the Unacademy Plus platform are 1 month, 3 months, 6 months, 12 months, and 24 months. The 1 month package costs you rupees 3150. The 3 month package costs you rupees 7875. The 6 months package costs you rupees 12,600. The 12 month package costs you rupees 15,750, and the 24 month package costs you rupees 18,900. While you make a choice for the subscription package that you want, please do not forget to use the code Prathik, Prathik, to get a discount of 10% on the list price. And the after discount price of the various packages for the CA Foundation and Intermediate subscription are: the 1 month package will cost you rupees 3150, the 3 month package will cost you rupees 7875, the 6 month package will cost you rupees 12,600, the 12 month package will cost you rupees 15,750, and the 24 month package will cost you rupees 18,900. So you see a reduction of 10% on it. If you compare the 1 month package per month cost of rupees 3,150 with the 12 month package cost per month of rupees 1,313, you will see it's almost 1/3 of the price. So I personally recommend you to go for the 12 month or the 24 month package for two reasons. One is it is cost effective, and secondly, it is the CA Foundation and the Intermediate subscription is being provided to you in one package. And normally for the CA Foundation and the Intermediate subscription, you require a preparation for 12 months to 24 months. So if you're looking for that, I request you all to make that choice of 12 months or 24 months as the case may be, and make use of the per month cost reduction as provided by the Plus platform of Unacademy. Please do not forget to use the code Prathik, Prathik, to get a discount of 10% on the listed price. I look forward and I encourage and I request all of you to get on board the Plus platform as soon as possible and make the most of this opportunity and benefit from this in the CA Foundation and Intermediate course. For those of you who have not yet followed my profile on Unacademy app, I request you to go to the Unacademy app, go to my profile, Prathik Gupta, Prathik Gupta, and click on the follow button to get live updates about the timings and topics of my session so that you never miss them and are on time for the session whenever. I also request you to go to YouTube and go through the various topics and sessions that I have conducted, and I hope you find it useful. And I would be happy to get a feedback or questions from you on any of those sessions. I thank you very much, and I shall be back with the Income from House Property Part 3, and I look forward to seeing all of you there. Thank you very much and take care.